Welcome, and thank you for tuning in. You're listening to the Beyond 50 radio program. I'm Daniel Davis. On the program today, we're going to be joined with someone with more than 30 years of experience as a certified financial practitioner. We're going to be talking today about a new approach to retirement investing that challenges the conventional thinking about stocks and bonds to offer a timely alternative. Today, we're going to learn how to design our asset retirement to protect and nurture the retiree nest egg, which most financial advisors lack specialized training in modern retirement theory and prefer to focus on the upside expectation rather than the many unseen risks. Primary risk being that retirees will not have the time needed to recover from portfolio losses without reducing their spending and compromising their standard of living. Joining us here on the program today is an income specialist, as I said, with more than 3 decades of planning experience. And what he talks about now is a strategy which calls for a historic shift in mindset that transforms things such as insurance from an incidental component of the retirement nest egg to a core holding. I'd like to welcome to the Beyond 50 radio program today our guest and author of the book Retire Reset: What You Need to Know and Your Financial Advisor May Not Be Telling You. Our guest today, Nahum Daniels. Nahum, thank you for being on the program today.
Thank you very, very much for having me. And by the way, that was a terrific presentation of my thesis.
Well, thank you very much. You know, when you take a look at financial books, especially when it comes to retirement, in my opinion, most of them seem to be regurgitating the same thing. And I think a lot of times people just kind of get turned off like, okay, well, here it is again. But really people should pay attention to what you have to say today because of the historical remarkableness that you write about in your book about what I would call the components of retirement. And first of all, what I would like to start with was the obvious one that you don't think about. Now, first of all, when we talk about retirement and nest eggs, things like that, most people think about their goals. Like, for instance, I decided I am going to retire by the age of 65. And so then you go to your financial planner, and of course you tell him this is the time that you would like to set your goal to retire and how much money you would like to have by the time that time occurs. And then you take a look at your age to see what you need to do to be able to achieve that goal. But as people are becoming aware of this day and age, it's what happens after you reach that goal that is something to really pay attention to. Let's go ahead and start there.
Okay. Now, where do we start? First of all, you said you used the term financial advisor. You know, it's very important for everyone to understand that modern retirement, because of longevity, is open-ended. And if you, for example, actually retired at 65, if you're in reasonably good health, you could easily live into your mid-80s, and frankly, as time passes between now and your turning 65, you could live well beyond your mid-80s, right into your mid-90s. If you have a spouse, she could live even longer than you because, you know, women live longer than men. Now we're talking about a retirement period that could last 30, 35, or 40 years. I just heard, maybe you did too, that I.M. Pei, the great Chinese architect and designer, just died. He was 102. Herman Wouk, the author of many great books, just died, 103. So we're dealing fundamentally with longevity. Now, when you go and sit down with your financial advisor and start talking seriously about retirement planning, if he or she does not remind you of what I just reminded you of, namely, you have an open-ended lifetime expectation, and it should go on for a really long time. and we have to plan financially accordingly, you should look for a different financial advisor, because longevity is what needs to be in front of everyone's consciousness from the get-go. Now, responding to longevity is complex. And over the last 20 years, there's a whole arena, a specialty arena called retirement planning that's been developed at universities and academic institutions. Intense research into the nature and complexity of retirement and the history of investing and insuring to understand what is the best balance between securities and insurance that makes sense when you're planning for an open-ended retirement period. And so the first thing to do when you're sitting with your financial advisor is to run by them some of the 50 questions that I include in Retire Reset, to ask advisors to determine whether he or she is really trained and equipped in retirement planning per se, and not just in insurance planning or investment planning, because it's something very new.
Now, let's talk about, for instance, what the number one rule in nest egg management. What would you call that?
Okay. First of all, we need to understand that our nest egg for retirement is not necessarily all of our wealth. The nest egg is a portfolio we put together specifically to generate a lifetime of income to address the fact that it could be open-ended. That's a challenge. Because if we take $1 and invest it today and say, I want to produce a certain level of income from that dollar for 30 or 40 years going forward, that's not easy. So the nest egg is a very specific subset of our wealth that's focused on generating a lifetime income. Obviously, we want it to generate as high an income as possible, and we want it to be a growing income because we have inflation to worry about, and we want to preserve purchasing power. Rule number 1, don't lose the money in your nest egg. It's designed to spend and spend and spend. You can spend it down to 0 and beyond. But the first rule of nest egg management is don't lose it to market risk. Why? Because the volatility of the markets will reduce our nest egg, especially if we're taking 3, 4, 5% a year out of it in the form of income. And if, for example, the market drops 10 or 20%, and meanwhile we're taking 5%, in 1 year we could see $1 million become $750,000. When that happens, we get scared and we start reducing our expenditures, which means we start limiting ourselves and imposing austerity on ourselves, and that means compromising our lifestyles. And we want to avoid doing that as much as possible. So, rule number 1, don't lose money in your nest egg. Now, if you have enough wealth so that the nest egg doesn't encompass everything you have, then that other wealth you can use to take risk. Go to Las Vegas. Invest in the stock market. Give it away to charity. But the nest egg needs to be protected, number one.
Now, as you were talking about here, about stock market and big market losses may be looming this year and next, tell us why that is.
Valuation. You know, market historians and market technicians are focused on valuation. In other words, the price we have to pay for a share of stock. Because research has shown, and we're getting a little technical here, but this is very important. The best way to project the future performance of stocks, and by future most people mean 10, 12 years, the best way to project the future performance, the future returns, is to examine the valuation, the price we have to pay for it in the present. And history shows that when prices for stocks are as high as they are today, the prospects going forward 10 or 12 years are very poor. So right now we know that the Dow and the S&P 500 and the NASDAQ, all of these measures of stock market performance are at historic highs. If we're buying in now, that's not great. And even if we own now, having bought in recently, we still face the fact that the next 10 or 12 years could be very, very disappointing. And it's because valuations today are so high that most historians of the market, most technicians are cautioning that we may be very disappointed with very low returns over the next 10 or 12 years. Now, if you're in retirement and counting on continued growth in the market, or if you're about to enter retirement, or if you're nearing retirement, and the next 10 years are going to be low return years, you don't want to get caught in that, because it will undo all of your future income projections. And it could trammel you and cause you to compromise your retirement dreams.
No doubt about that. You know, when you talk about the major risks that face the retirement investors that can take them and their advisors by complete surprise, what major risks would we consider here?
Well, as an extension of what I had just said, you know, disappointing returns over the next decade can come in a number of different fashions. Number one, we could get a serious correction or crash of 30, 40, 50% or more. Now, there are some market historians out there who are very outspoken about the risk that we could be facing a major adjustment in valuation to get us back to the historical norms. That would not be pretty. It will come as a surprise because we don't want to believe that it's coming. We have many psychological tics about our financial portfolio, and one of them is we're always looking for affirmation that our dreams will come true. And markets can only go in one direction, namely up. So we are psychologically inclined, and by the way, that's not just us investors, but that's for us financial advisors as well. we financial advisors are as human as our clients. And we want the markets to continually rise just as much as our clients do. So we're inclined. We're inclined to expect. We want to expect. We don't want to wake up every morning and say, oh my, is today the day that the reckoning is going to occur and the great leveling is going to affect us. We don't want to live with that anxiety, and so we avoid it, and so do our financial advisors, and for many other psychological reasons as well. Therefore, the bottom line is this. When it comes, we will all be surprised, and that's the nature of a financial crisis. We're all surprised, and when it hits fast, and it hits furious. That happened in 1929, and it happened in 2008. Nobody was expecting the kind of 50 to 60% fall in the S&P 500 that hit us in 2007, 2008. No one was predicting it. The same thing in 2000, when the tech stocks took their great crash of 80%. No one was expecting it. When that happened in 1999, all of the Wall Street pundits were telling us that the market, because of technological innovation, had a 12% a year expected return. Oh my. Because in the following 2 years, the exact opposite happened, and we had to live through a crash. Same as in 08. So when I say that we could get caught by surprise, we will get caught by surprise because psychologically we are simply not inclined to contemplate painful corrections like these. By the way, what I say in my book is that what distinguishes me and my kind of advisor is that when I get up every morning and get in my car to drive to the office, I do think about, is today the day that we're going to get that reckoning? And you want your advisor to be the nervous type, because someone has to be concerned about the inevitability of a financial reckoning. And it's my view that a retirement advisor in particular needs to be focused on protecting clients from getting caught in that kind of great leveling.
Now, tell us how conventional index investing might fail retirees.
Again, good question, and it's an extension of what we've been talking about. Most retirees today, most investors today, have gone the direction of cheap index investing. This was an invention of John Bogle, the founder of Vanguard. One of the largest, I think it is the largest mutual fund company in the world today, who said, look, you want to invest for the long term, the average investor should just buy the S&P 500 index and perhaps buy a bond index as well to kind of balance the portfolio. Pay as little as possible in terms of management fees and just hold on for dear life. He admitted that, look, we're going to have a roller coaster experience of the market going up, and then the market going down, and then the market going up again and down again. But if you hold long enough and can stomach the volatility and the risk, long term, 20 years, 30 years, you're going to get the best return. And millions of retail investors today follow the Bogle Vanguard strategy and, frankly, are buying the market indices blindly. But when that roller coaster takes its downward lap, those are the stocks that are going to lead us down into losses. And so index investing without downside protection is very ill-advised, especially for retirees who simply cannot afford, no less tolerate, losses like those.
Wow, it's just, so much to take in, and you think about how can an investor tell if a financial is properly trained with all this going on.
That's very, you're right on, and that's why after each of the 10 chapters in my book, I include 5 specific questions that are extensions of the stuff I talk about in each chapter to say, okay, now go to your advisor and say, how about this? How about this? What is your view of the future? What happens if I get caught in a downturn? And by the way, what happens if that downturn isn't 6 months or a year or 2 years? Japan took a downturn in 1989. I tell the story about a Japanese couple who came to see me in the late noughts, 2009. It's 30 years later, and the Japanese equivalent of the S&P 500 is still down 50% from the high that it reached in November of 1989. Think about that. Hey, the same thing happened here in the good old USA when the market fell during the Depression, leading into the Depression. It fell a total of 90% between 29 and 32. And it didn't climb back to its 1929 value until 1954. Now that is 24 years. Now, are we going to have that kind of experience again? I don't know. It's not impossible. It's happened once here in the U.S. of A. We know that Japan has been dealing with it for 30 years. So the point is, these things might happen. They can happen. There's a risk. And what I argue in Retire Reset is, don't take that risk because it could mean financial ruin in retirement. And why submit yourself to it if you don't have to? And there are alternative ways to invest to get sufficient returns so that you can live your desired lifestyle and sustain it in retirement. In other words, let's not take more risk than we have to, because not only might it go uncompensated, in other words, we won't get an appropriate return for the amount of risk we're taking, we could get really hurt. And I argue in Retire Reset that the primary responsibility of your financial advisor when talking about retirement is not to make you rich. It is to keep you from getting hurt. And if you can make some money while you're protected from getting hurt, that would be ideal.
It's just amazing to think of how much there is to consider here when it comes to retirement, and your book certainly outlines a lot of great detail, not only in what you face, in different arenas, for instance, banks, government. You talk about Wall Street. Again, for the listeners out there, this is a book that is rich in history so that you don't have surprises about the fact that in the end, we got a bunch of human minds and hands into the clockwork here, and so not everybody's really looking out for your best interest all the way around. And the more you're armed with good information like your book provides, the better off you are at asking the right questions about someone who's a financial planner and being able to achieve the kind of goals that you're looking for. So I guess my final question would be, what differentiates the nest egg from an investor's other holdings?
Well, again, the nest egg needs to be focused on providing a cash flow, a healthy as possible cash flow for as long as possible, indeed, for an entire lifetime, the length of which is very hard to measure these days. It should go into our hundreds. So it has a big job ahead of it. It needs to be protected. It needs to be optimized. We want to get as big a yield as possible from each dollar in our nest egg. We want that return, that income to grow, to keep up with inflation, to keep our purchasing power intact. And if possible, we want to have that outcome guaranteed, because failure is really not an option. Failure in retirement isn't pretty. Those are the 4 rules around your nest egg assets. Now, as I said, if you're fortunate enough, after you sit down and done a plan, and you have determined, you have sized your nest egg properly, and you say, okay, I need $500,000 in my nest egg, but I'm sitting on $750,000. Well, that remaining $250,000, well, maybe you should take more risk. Maybe you could put that into the stock market. Maybe you could invest that in real estate. There is a place, of course, for all types of securities and investments. But we want to know which dollars are available and how many are available for those specific purposes. For a very wealthy person who actually lives modestly, the nest egg might be only 20 or 30% of the total wealth holdings. And the great majority of a person's wealth should be used to take risk if that's what you want to do. On the other hand, for smaller estates and accumulations, much maybe 50, 60, 70% of an entire family's wealth might constitute nest egg. So the difference is what assets are focused on income production for an open-ended future, and what assets remain to be exposed to different kinds of risk on the prospect of getting a higher current return through growth. That's the key difference between the nest egg and the rest of your wealth.
Gotcha. I want to thank you for taking the time to be on the program today and sharing this information with our listeners. And again, like I want to tell our listeners, take a look at this book. It'll really surprise you what's in there. Especially, the rich history that you have about how things have been and how they have worked, and why you really need to pay attention and get away from mainstream advice and really get in there to make sure that you're doing the right thing for yourself. Is there a website people can find out more about your work and how they can get the book, things like that?
Sure, thank you. First, the book's on Amazon. My website is integratedretirementadvisors.com. integratedretirementadvisors.com. And from my website, you can reach my blog and my social media, etc. If you look at Nahum Daniels, CFP, you can find Facebook and LinkedIn. The best place to go is integratedretirementadvisors.com, and go up to Amazon. You can order the book in electronic format, or if you're old-fashioned like me, you can order a bound paper copy. But I thank you for, obviously, the work you did to prepare, to look at the book, to read the book, and understand. There's a lot more in that book than just what we've talked about today. I tried to give the background, the rationale for the advice that I'm giving. And so we do have to talk about the Depression and banking and insurance and what distinguishes banks from insurance companies, what they each do, what their strengths, what their weaknesses are. These are all things that a retiree who's really serious about succeeding and becoming a last winner in retirement, these are all things that everybody needs to understand. And that's done.
Well, thank you, Nahum, for being on the program today and talking to our listeners about what to do out there.
My pleasure. Daniel, thank you very much for having me.
You bet. We want to thank you, the listeners out there, for joining us. You can also discover more at beyond50radio.com. That is the number 50. We do encourage you to sign up for our weekly e-newsletter to keep up to date with what's going on in the world of Beyond 50, as well as our upcoming programs. I'm Daniel Davis. Again, thank you for joining us. This is the Beyond 50 radio program, and remember, live your day past halfway.